Okay, everyone, welcome to the third video of your banking simulation program. So this video is all around the decisions that you're going to need to make. So in the last video, we spoke to you a lot about the information you're going to receive. This is going to focus on what you need to do with that information. Okay, so let's go back to our banking simulation interface. Now, down the bottom, you'll notice that we've clicked on the decisions area and we've gone to the businesses tab. So what you can see here is each of our products: mortgages, business lending, deposits, and credit cards. And if we click on mortgages, you'll see it turns a light shade of blue. So you'll notice a couple of things. You can see the interest rate we were charging our customers, the interest rate we're proposing to charge. And if you pull this little slider to the right or to the left, you will see the price changes. So in this example here, we've dropped our price by 10 basis points. You can see down the bottom, there's a secondary lever. In this example, it's the broker commission. So how much are we paying our brokers to help push our loans out there? So in this example here, it works exactly the same way, but we've actually increased the commission that we're paying our brokers. Now that's going to mean that it costs us more money because we're going to pay brokers more, but we're hoping that they help drive volume for us. There is a difference in the risk of customers that come through the broker channel. So that's something you want to bear in mind. Okay, so let's talk about business loans. Business loans works in exactly the same way. So you just use a little slider. What you'll notice down the bottom is the lending criteria. So you can write either loose, medium, or tight. So notice you can click on each of the different options there. There are trade-offs to consider. So if you were to write loose, you would probably pick up a lot more customers. If the economic cycle turns, those customers are less creditworthy and you're going to experience more losses. You could write tight as well. And that would mean that you are being very strict on who you're lending to, but you're probably foregoing growth. If the economic environment turns, you might experience less losses. Now, deposits works the opposite way to the other products. So remember, if you are trying to incentivize deposit customers to leave their money at your bank, you need to pay them more. So the top slider works in the exact same way, but I've actually increased my price by 8 basis points because I want to attract more customers. And the bottom piece here is the points of presence. So this is your branches, your ATMs, your kiosks. Each of these costs you $1 million to open, and you can also close them, but it only saves you $500,000 if you do close them. And then the last piece here is your credit card. So for credit cards, the price lever is the annual fee. How much fee do you want to charge your customers? And then you've got reward points. So this is the reward points that you get for every dollar of spend. So customers love this because every time they make spending, they earn some points, but those points actually cost you as a bank. Okay, so there are two screens here. Let's go to the second of our screens and let's talk a little bit about the price and a volume trade-off, something which banks really obsess with out there. So what you'll notice up the top here is the price that we've been offering to our customers. So you can see in blue the historic prices, and in orange is the price that we're actually proposing now, 5.22%. You can see on the right-hand side the volume that we've actually been achieving. That's in blue, and the orange piece here is the forecast volume we think we might achieve. Let's click on mortgages by way of example. So what you'll notice here is that our income is estimated to increase by 6.4%. Well, how is that happening? What you'll see is that our price is 5.22%, and we've assumed a small uplift in our volume estimate, 2%, which probably is in line with where that breaking news was telling us the market is going to grow. Now, let's say I'm on your team and I decide that we need to cut our prices because we want to pick up a lot of volume. So you'll notice here I dropped the price from 5.22 to 5.07%. Now, in order to generate that same 6.4% income growth, I'm going to actually need my volume to increase by 8%. So it was 2% before and now it's 8%. Now, this is an estimated volume. The amount of volume I'm actually going to achieve will depend on how I am versus all my competitors and all the different strategies. The point here is that you'll notice that you need to get 4 times the volume growth you previously were achieving just in order to achieve the same level of income growth. So you want to think carefully when you're making price changes as to whether or not you think you can support them with the volume that's required to make them attractive. Okay, so the next decision you need to make is called special projects. So what you'll find here is you've got a number of different projects available to invest in. And each of these projects you'll find have actually got different costs. Each of them have different benefits and different positives or drawbacks for you. And the way you select a project is you click on this select button and the project will actually turn selected. Now you can only choose one project per year. So you've only got 4 years in this, so you've got 4 projects to choose from out of the entire 10. So think carefully about what you're going to invest in and why you're actually going to invest in. And there's an opportunity cost with each of these projects because every time you're investing in one initiative, that means another initiative you like might need to be foregone or perhaps deferred. Now, I know a lot of people have had some exposure to mergers and acquisitions, perhaps through your university. And what we will do is we're going to give you the opportunity to buy another business. That's going to be in round 2. Now, we don't want you to worry about the maths around the valuation too much. We'll help you with that, but we're going to get you to think about some of those commercial issues and also the risk around an acquisition and whether or not you think that the price that you're paying adequately compensates you for the risk. So that's this particular video. In the next video, I'm going to cover treasury because treasury is an area which a lot of people in the banks themselves do not have a good understanding of. So we'll do that piece in the separate and the final video.